You do the math on a Tuesday night and something breaks. Median salary, $56,000 a year. Take home after taxes, $3,640 a month. The average American home right now costs $420,400. A standard 20% down payment is $84,080, saves $600 a month. Aggressively, skipping everything, you reach it in 11.7 years. Except you don't, because in 12 years, that same home costs $755,000. The new down payment is $151,000. You just spent a decade running toward a target that was accelerating away from you the entire time. That's not inflation. That's not bad timing. That's not a coincidence. There are $1.7 trillion in student loans sitting on our generation's chest right now. Housing costs have increased over 400% since 1980, while real wages flatlined for 40 years. And somehow, we were all handed the same sentence before age 22. Stop throwing money away on rent, buy as soon as you can. That's how real wealth works. That's not advice. That's a trap. And the mechanism behind it, who built it, how it runs, and who collects every month you believe in it, that part hasn't started yet. This didn't happen by accident. In 1944, the GI Bill sent returning veterans into a housing market where the median home cost $7,354, roughly 2.2 times the average annual income. The math worked. By 1970, a single factory worker could buy a house, raise 3 kids, and retire on a pension, all on one income. No degree required. Median home price sat at 3.1 times median household earnings. Then came 1980, and something shifted permanently. Interest rates spiked to 18%. The Reagan administration cut federal housing subsidies by 75% across 4 years. Restrictive zoning laws tightened across every major metro. Affordable housing construction collapsed and never recovered. New housing starts in 2023 were still 30% below the 50-year average needed to meet demand. That wasn't market forces acting neutrally. That was policy, layered on policy, each decision narrowing the door a little further, each decade making the entry cost a little more impossible. When a boomer graduated in 1980 carrying a bachelor's degree, the average student loan balance was under $2,000. The median home cost $64,600, roughly 3.4 times the average annual wage. They needed to save for about 1 year to reach a 20% down payment. We graduated into $37,000 in average student debt, facing a median home price 7 times our starting salary. And were handed the exact same sentence with full conviction. Same advice, completely different math. And the cruelest layer isn't financial, it's psychological. We were trained to feel shame for failing to achieve something structurally impossible. Rent became throwing money away. Not buying was coded as immaturity, irresponsibility, and inability to sacrifice. That shame kept us saving toward a number that kept accelerating away and kept us quiet about why the trap doesn't need locks when the captive believes the failure is personal. Let's be precise about who is sitting on the other side of this equation, because it isn't bad luck, and it isn't the market. Wells Fargo, J.P. Morgan Chase, and Bank of America collectively generated over $11 billion in mortgage interest revenue in 2023 alone. On a single $420,000 loan at 7%, a bank collects $538,000 in pure interest across 30 years, meaning you pay nearly $960,000 for an asset that costs $420,000. They call that a service. The National Association of Realtors pulls in over $85 billion in annual commission revenue and spent $84 million lobbying in 2023 specifically to block zoning reforms that would have increased supply and lowered prices. Think about that. $84 million deployed to make sure housing stays expensive. This isn't the invisible hand of the market. This is a hand you can see, attached to an arm you can trace, connected to a revenue model that requires your entry price to stay exactly as high as it is. Every reform that didn't pass, every zoning change that got killed in committee, every affordable housing development that never broke ground, there's a dollar amount attached to each of those outcomes. And somebody collected it. Then there's the layer our parents never saw coming, the one that sealed the exit permanently. Between 2022 and 2023, institutional investors including Invitation Homes, Progress Residential, and funds backed by Blackstone purchased 1 in every 4 single-family homes in major U.S. markets, not to live in, to rent back to us. They captured the supply, converted it into rental inventory, and now collect the monthly payments from the exact generation that was told to stop throwing money away on rent. The median net worth of a homeowner in America today is $396,200. The median net worth of a renter is $10,400. That $385,000 gap is not a lifestyle difference, it is a structural extraction, compounding annually, engineered by an incentive system where the winners need the losers to keep playing by the old rules. A workforce that can't own anything is a workforce that can't afford to leave. And here's the number that changes everything. The mechanism that turned rental payments into tax-advantaged cash flow for institutional buyers was made possible by a specific policy change most people have never heard of. That part comes next. Here's what they didn't teach us in school, and not by accident. The U.S. Department of Education requires 0 credits of personal finance to graduate high school. 17 states still have no mandatory financial literacy curriculum at all. The result isn't ignorance by default, it's ignorance by design. Because the same compound interest that should feel like a weapon pointed at us was marketed as the miracle of savings accounts. Every financial advertisement we ever saw showed compound interest working for you, building your retirement, growing your future. Nobody ran that same demonstration in reverse, what compound interest does when we're the borrowers, not the savers. On a $37,000 student loan at 6.5%, compound interest adds $44,000 over 20 years of minimum payments. We repay $81,000 for $37,000 borrowed, then they hand us a credit score that only improves if we take on more debt, meaning we must go further into the system to prove we're trustworthy enough to go deeper into the system. That's not a financial infrastructure. That's a harvest. And the mechanism runs deeper than our loan statements. The U.S. tax code contains over 70,000 pages, and the most important thing it reveals is what it rewards. Wages, what we earn selling our time, are taxed at rates up to 37%. Capital gains, what the already wealthy earn when their assets appreciate, are capped at 20%, often 15%, sometimes 0. A landlord owning 10 properties can depreciate assets, deduct maintenance expenses, and defer capital gains indefinitely through 1031 exchanges. Paying a lower effective rate than a nurse making $65,000 a year, the same tax code that extracts maximum value from our labor actively subsidizes the accumulation of the assets we can no longer afford to buy. Then add inflation running at 8.3% in 2022, meaning every dollar we saved toward that down payment was quietly losing real purchasing power while the target price climbed. The goalpost didn't just move, it accelerated on every axis simultaneously. And the math, proving exactly how fast, that's where nothing you believed about this system survives. Let's start with $56,000, the median Gen Z household income, not a failure number. The exact mathematical middle of what our generation earns, federal taxes at 22%, state taxes averaging 4.6%, FICA at 7.65%. Before spending a single dollar, roughly 24% is already gone. What remains? $42,560 annually, $3,547 a month. That is our operating budget. The entire promise of homeownership is built on that number. And right here, before rent, before food, before a loan payment, 1 in every $4 we earned has already left our hands. Most people accept that as normal and move forward. But this is where the math becomes a verdict, because $3,547 is not a comfortable foundation. It's a number with no margin for what the system requires next. And what the system requires next is where the calculation stops being arithmetic and starts being a confession. Now we stack the unavoidable's median rent for a one-bedroom in a mid-tier American city, $1,800. That's not Manhattan, that's Columbus, Charlotte, Phoenix, national median, student loan minimum payment on $37,000 at 6.5%, $418, health insurance premium, employer subsidized for a 25-year-old, $306, transportation, car payment, insurance, gas, for anyone outside the 4 cities with functional public transit, $487, groceries, $300, utilities, $180, we haven't touched a restaurant, an emergency fund, or a single dollar toward a down payment. Running total, $3,491, Monthly take-home, $3,547, remaining $56. That is the margin the median Gen Z worker has after doing everything correctly, following every instruction, earning the median wage, not a rounding error, a structural proof. And the only question left is, if $56 is everything that remains, how exactly is anyone supposed to save $84,000? The answer is, they're not. But let's follow the math anyway, because what happens when someone actually tries is the most damning calculation in this entire story. Suppose you cut everything, no car, every meal cooked at home, every subscription canceled. You free up $600 a month toward that $84,080 down payment. You reach it in 11.7 years. Except homes have appreciated at an average 5.4% annually since 2012. Apply that rate to $420,400 over 12 years, and the same home now costs $755,000. New 20% down payment, $151,000. You saved for a decade, and you are $67,000 further from the finish line than when you started. The goalpost moved $67,000 while you were running at full speed. That's compound appreciation functioning as a structural barrier calibrated to outpace median income savings at exactly the rate required to keep the door permanently closed. Not a discipline failure, a design feature. The number that breaks everything isn't the down payment. It's what happens the moment you actually buy, assuming, somehow, you manage to reach that first threshold. Go back to the median scenario, $420,400 home, 7% fixed rate, 30 years. Monthly mortgage, principal and interest, $2,237. Property tax at the national average, $350. Homeowners insurance, $150. Maintenance, the 1%. Annual rule every financial advisor swears by, $350. Total real monthly housing cost, $3,087. Monthly take-home on $56,000, $3,547. That leaves $460 for everything else. Food, transportation, student loans, healthcare, utilities. You need at least $1,800 just for those. Which means buying the median home on the median income puts you $1,247 in the red every single month. You did everything right, you qualified, you closed, you moved in, and you are going backwards by $1,200 a month. That is not a budgeting failure. That is a verdict written into the structure before you ever signed. This is the moment it stops feeling like bad luck and starts feeling like something deliberate. Because once you see negative $1,247, you can't unknow what it proves. Every conversation we ever had about adulting, every time someone looked at us with quiet disappointment and asked why we hadn't bought yet, every finance influencer showing a 26-year-old with a mortgage like it was simply a decision they made, all of it lands differently now. We weren't failing a test, we were running an equation that was never calibrated to balance on our side. The anger that builds here isn't irrational, it's mathematically precise. When a system produces the same impossible outcome across millions of people working different jobs, different cities, different choices, all arriving at the same wall, that is not a personal failing. That is a mechanism functioning exactly as its architects intended it to function. And here is the clarifying fact that makes the rest of this undeniable. If this were a design flaw, someone would have corrected it. The 30-year fixed mortgage has existed since 1934. The wage-to-home price ratio has deteriorated in a straight line since 1980. Zoning reform has been killed in committee for 5 consecutive decades. Student debt has compounded every year since 2003 without a single structural correction. None of these are oversights. They persisted because specific institutions, with names, with earnings calls, with lobbying budgets collected revenue on every year, this equation stayed exactly as impossible as it is. The system isn't broken, it's working exactly as designed. A generation that cannot build equity cannot build independence. A generation that cannot build independence cannot negotiate, cannot leave, cannot say no. The math that proves you cannot afford to buy is the same math that proves someone else cannot afford for you to. Here's what the next 5 years look like if nothing changes, not in theory, but in math. Median asking rent rose 26% between 2020 and 2024. Median wages grew 4.3% in the same window. Every month we stay in this rental market, the gap between what we earn and what we owe quietly widens. Student loan interest compounds regardless of whether we're making progress. The emergency fund we were told to build 3 to 6 months of expenses, $10,000 to $20,000, is mathematically unreachable on $56 in monthly margin. One medical bill averaging $1,200 out of pocket, one car repair, 1 month of reduced hours, the savings reset to zero, the timeline resets to zero, and we start again from a floor that is slightly higher than it was before. 78% of Gen Z reports significant financial anxiety. That number isn't a mental health statistic. It's a precise measurement of what it feels like to run a calculation that doesn't close every single month while being told the problem is discipline. Between 5 and 15 years from now, the damage stops being monthly and becomes permanent. Homeownership closes as a mathematical option in more than 70% of U.S. metros for households, earning median wages not because prices are temporarily high, but because the structural gap between appreciation rates and income growth is a one-way door. The median homeowner's net worth today is $396,200. The median renter's net worth is $10,400. That $385,800 gap is not a lifestyle choice. It is a compounding structural extraction that widens every year the two groups stay in their respective positions. Without equity, there is no asset to borrow against, no platform to take risk from, no financial floor beneath any career decision. We can't quit a job we hate. We can't negotiate harder. We can't take a pay cut to build something better. The golden handcuffs don't require gold. They work just as well when they're made of debt. Every year we stay in the system as renters, the window to exit narrows, and at some point, the window doesn't close. It disappears. 30 years out, the math stops being a projection and becomes a eulogy. No equity to pass down, no asset to sell in retirement. Renting on a fixed income in a market with no structural rent controls, while Social Security, already running a projected shortfall by 2034, was never designed to cover what rent will cost then. The financial floor our parents stood on was real. The ladder they used to reach it existed. What we inherited is a market where that ladder was quietly pulled up, disassembled, and sold to a real estate investment trust that now charges us monthly to stand in the same yard. The cruelest part isn't the math, it's the shame layered over it, the internalized belief that this outcome is personal, that we failed some test of adulthood, that our generation simply lacks the discipline our parents had. That shame is the final mechanism. It keeps us quiet. It keeps us blaming ourselves instead of reading the structure. This is not a personal failure. This is systematic extraction running exactly on schedule. Here is what shifts the moment you see this clearly. You stop asking the wrong question. Should I buy or rent? Stopped being a financial decision the moment it became a loyalty test to a system never calibrated to let us win. The real question is why a biological necessity, shelter, was engineered to carry 30 years of interest extraction as the precondition for middle-class participation. This is hard. The system made it hard on purpose, but now you see it, and you can't unsee it. The shame layered over this outcome, every disappointed look when someone asked why we hadn't bought yet, every finance account presenting a 26-year-old homeowner like it was simply a choice they made, none of that was information about our discipline. It was pressure engineered to keep us running toward a number the math had already disqualified us from reaching. Seeing the mechanism is not the same as escaping it. It is the only starting point that isn't itself a trap, and that is more than most people who are still running will ever have. The principle isn't, don't buy a house. The principle is, stop optimizing inside a structure designed to extract from you and calling the debt wealth. Understand what actually builds equity, what assets generate return without encumbering 3 decades of your income, and who decided real estate was the only path to financial independence and why they needed you to believe it. You're not losing because you're stupid. You're losing because no one taught you the real rules, and the people who know them built an entire industry on that gap. Our generation didn't fail to achieve the American dream. We ran the math and found out it was sold to us by the people who owned the bank that holds the deed. The system isn't broken. It's working exactly as designed. So ask yourself this: how much of your financial future has already been pre-committed to someone else's revenue model before you ever made a single choice? Next, we show you exactly who is buying all these homes and the legal mechanism that turned your monthly rent payment into their tax-advantaged cash flow.